Welcome back to Theta Fuse. It is January 19th, 2026.
It is.
And if you're listening to this, you probably started your day checking the headlines, maybe while brewing what felt like a very expensive cup of coffee.
Agree.
And if you did, you likely saw a number that made you want to, I don't know, check your banking app right away. Inflation is up.
That's the story.
The press is using these dramatic words like steaming up, heating up, and the big headline number they're all throwing around is 2.4%.
It is definitely the number of the day.
It is.
I gotta admit, when I saw that pop up on my screen this morning, 2.4% in December, when, all the economists were expecting maybe 2.2. His stomach dropped a little.
Mine too.
We've spent so much time, hoping and praying for that soft landing, and then you see the arrow point up again. It just feels like, here we go again.
It feels like we're back at square one. Like the cost of living crisis is booking a sequel nobody asked for.
Exactly. It triggers that reflex. But, and this is why we're doing this deep dive, I spent the whole morning just tearing apart the reports from StatsCan, all the notes from the big bank economists, the tables, and I'm going to make a bold claim right off the top here. This isn't a crisis. It's a head fake.
A head fake.
The complete statistical mirage. I mean, if you look at the raw math, the sky is not falling. In fact, it's actually clearing up quite nicely.
Okay, but, and here's the massive but, if you are standing in a checkout aisle, right?
Right.
Specifically the one with the coffee and the beef, it does not feel like a mirage. It feels, frankly, like a robbery.
And that is the tension right there. That's the whole story today.
We have this macroeconomic picture that you're saying is actually cooling down.
It is.
And this microeconomic reality, my grocery bill, that is still on fire.
Wow.
And then, just to make everyone even more confused, we've got the stock market, the TSX here in Canada, looking at this whole mess and what? Cheering?
It seems completely broken, doesn't it? Inflation's up, groceries are through the roof, yet Bay Street is partying.
It makes zero sense on the surface.
It makes perfect sense when you see what is actually driving the TSX. It is not the consumer.
Okay.
It's materials. We're looking at a report today from Scotia Capital that is predicting an earnings explosion in the materials sector that's, well, it's frankly hard to believe.
Okay, so we are going to unpack all of that. We need to explain why this 2.4% number is mostly what the pros are calling tax noise.
Exactly.
We've got to figure out why my morning coffee has suddenly become a luxury asset. And we are going to tear apart this wild prediction. What was it, 112% earnings jump for materials?
112%. It is a staggering number.
And then finally, the big question, what does the Bank of Canada do with all this conflicting data? Do they hold, do they cut, or do they, panic?
It's a really complex picture, but it tells the story of exactly where Canada is in early 2026. So let's start with the scary part, that headline number.
2.4%. Why did it jump so much? Why were the economists wrong?
Okay, so to understand the jump, you have to sort of ignore the economics for a second and just look at the calendar.
The calendar.
We need to hop in a time machine and go back exactly 1 year. Think back to December 2024. Do you remember what the federal government did right before the holidays?
I do, yeah. It was that holiday relief package. They paused the GST, the HST on a bunch of specific things to give people a break.
Exactly. It was a temporary stimulus. So for a few months, December 2024 through early 2025, prices on things like kids' clothing, toys, restaurant meals, that kind of stuff, were artificially lower.
Right.
Not because the cost to make them went down, but just because the tax was gone at the register.
It was a nice little break.
Right.
But it was, as you said, temporary.
Correct. It ended. So now here we are, January 2026, looking at data for December 2025.
Okay.
When Statistics Canada calculates inflation, it's a year-over-year comparison. They're comparing prices today, which have the normal tax on them, against prices from December 2024, which had the tax removed.
Oh, I see it now. So you're comparing a full price month to a discounted month.
Precisely. It is a textbook base year effect.
Yeah.
It's just a mathematical quirk.
Yeah.
If you lower the floor, the ceiling looks a lot higher.
Right.
And StatsCan was actually really clear about this in their report notes, which nobody reads except people like us.
Of course.
They said the GST-HST holiday from last year is the primary factor. It's not that prices suddenly shot up this month from some runaway demand. It's just that we're comparing normal pricing to artificially suppressed pricing.
So it's like, okay, if you were on a strict diet last year for 1 month and lost 10 pounds, and then this year you're back at your normal weight, the scale says you gained weight.
That's it.
But really, you just stopped the temporary diet.
That's the perfect analogy. You haven't become unhealthy. You just return to your baseline. And that's why you see economists, you know, Douglas Porter at BMO, the team at TD, they're all calling this noise.
And when an economist calls data noise, what they mean is don't build your strategy around this.
Exactly.
Hmm.
They're looking past the headline because they know it's distorted by the tax calendar.
But that requires a level of analysis that, most people just glancing at a headline don't have. We just see 2.4% and we think, oh no, prices are rising fast again.
Which is why we dig deeper. So let's do that. Let's strip out the noise. Let's ignore the tax trickery and look at what the economy is actually doing. Is the engine hot or cold?
Okay, so this is where we have to look at the core measures, right?
Exactly.
Yeah.
The Bank of Canada doesn't panic over headline numbers. They look at the trend. And they prefer two very specific metrics.
Yeah.
CPI trim and CPI median.
Okay, let's just pause on those for a second. We hear those terms, CPI trim, CPI median, thrown around on business news all the time. Can you just quickly define them? Because I feel like people nod along but don't actually know what the math is doing.
Sure. So headline CPI is everything. It takes the whole basket, gas, bananas, cars, rent, and averages it. But some of that stuff is really volatile. If a hurricane wipes out the orange crop in Florida and juice prices triple, that spikes the headline.
But it doesn't mean the whole Canadian economy is overheating.
Exactly. So CPI trim literally takes the items that went up the most and the items that went down the most, the extreme outliers, and just chops them off. It trims the tails to see what the middle of the pack is doing.
Okay.
And CPI median is even simpler. It just lines up every single price change, lowest to highest, and picks the one exactly in the middle, the median.
So it's a way of filtering out the freak events, like a one-time tax holiday or a weird weather event.
Precisely. It gives you the underlying pulse. And right now, those core measures are, they're behaving exactly how the central bank wants them to. In December, both of them slowed down.
Slowed down.
But here's the really important number. If you look at the 3-month trends, so just the momentum over the last quarter, CPI trim is running at an annualized rate of 1.5%. And CPI median is at 1.9%.
Whoa, wait a minute. The Bank of Canada's target is 2%.
That is the magic number.
So you're telling me that the underlying pulse of inflation, the real momentum,
Yes.
is actually running below the target.
It is. And that is the head fake we were talking about at the top. The headline screams 2.4%, which looks like we're overheating. But the core momentum is actually undershooting the target. That is a massive, massive divergence.
Wow.
If you are Tiff Macklem at the Bank of Canada, you're looking at that 1.5% trim number and you're thinking, we might actually be cooling too much.
That is fascinating. It's almost like the headline is designed to cause panic, but the real details are screaming that the job is done.
And there's another huge factor dragging the numbers down, isn't there?
Oh, yeah. The pump.
Absolutely. Gasoline is the other huge story here. It is acting as a massive anchor on inflation right now. Year over year, gas prices are down significantly.
I've noticed it filling up.
Depending on whether you're looking at the November or December numbers, we are seeing drops of 7.8% to almost 14%.
That's a huge drop. So why is gas so cheap right now? Is it just that people aren't driving?
It's mostly supply. Crude oil is trading at its lowest point in over 4 years. There is just a global oversupply of oil. You have production in the Americas pumping at record rates. You have, lackluster demand from China, which is still struggling to get its momentum back. The world is just awash in oil.
So every time you fill up your car, you are actually experiencing deflation compared to last year.
You are. And that's pulling the whole average down.
Okay, let's summarize this first part. The headline, 2.4%, is largely a tax calendar glitch. The core inflation, the stuff that really matters, is actually running cool, below 2%. And gas is cheap.
That is the analytical view. Correct.
Okay, so the analyst in you says, everything is fine, the system works. But then I take off my analyst hat and I put on my person who needs to eat breakfast hat, and suddenly I don't care about base year effects or CPI trim. I care that my grocery bill is exploding.
And this is the disconnect. You can't eat core inflation, you eat food. And the data on food purchased from stores is, it's undeniably ugly.
It is brutal. I was looking at the breakdown, and while the overall number is cooling, the grocery aisle is a different planet. Food from stores is up around 5%, but that average is hiding some absolutely massive outliers.
The outliers are extreme.
Yeah.
And they're hitting the things people feel, in their daily rituals.
Let's talk about the big one, coffee.
Oh, the coffee situation is dire.
I saw the number in the report, and I honestly thought it was a typo. Up 27.8% year over year.
Not a typo. It is a crisis for caffeine addicts everywhere.
Nearly 30%. That's not inflation, that's a price shock. What on earth is going on there? Is it just corporate greed? Is it shipping?
It's actually a perfect storm of supply issues. You have two main things just slamming the coffee market at once.
Okay.
First, you've got terrible weather in the major growing regions. We've seen droughts, bad conditions in places like Brazil and Vietnam.
And they're huge producers.
Huge.
Yeah.
Vietnam is critical for Robusta beans. That's the stuff in your instant coffee, your espresso blends. Brazil is the king of Arabica. Both just got hammered by climate patterns. Less beans means higher prices. Simple supply and demand.
You're right, so Mother Nature is charging us a premium. What's the other part?
Politics. We have the impact of U.S. tariffs on coffee-producing countries.
Wait, hold on. We're in Canada. How do American tariffs affect the price of coffee at a Tim Hortons in Toronto?
It's a great question. The North American market is just so deeply integrated. Logistics, shipping lanes, roasting facilities, they cross the border all the time. So if the U.S. slaps a tariff on, say, Colombian coffee, it disrupts the entire chain.
It adds friction.
It adds a ton of friction. Suppliers might reroute shipments, which costs more. Hedging costs go up. And generally, the pricing structure for the whole continent adjusts to the new tariffed reality. So you have bad weather restricting supply and trade wars adding cost. Result: your morning latte is now a luxury item.
It really feels like it. And it's not just the coffee. The other one that just jumped out at me, I noticed this at the butcher counter last week, is beef.
Yes. Beef prices up 17.7%.
17.7. It's huge. Why? Is that a weather thing too?
This one is more of a structural cycle. It's all about herd sizes. We're dealing with what economists call a biological lag.
A biological lag.
You can't 3D print a cow. It takes years to grow cattle to market weight. A few years ago, 22, 23, we had severe droughts and really high feed costs across the prairies and the U.S. Midwest.
I remember that.
So farmers couldn't afford to feed these massive herds, so they culled them. They sold off the cows early to cut costs.
They shrank the inventory to survive.
It's significantly. The North American cattle herd is at a historically low level right now. But demand is back, people want steaks, but the cows just aren't there. And it takes a long time to rebuild a herd. We're still feeling the effects of that cull. Less cattle, less beef, higher prices.
So we are literally paying today for the tough decisions that were made on farms 3 years ago.
Exactly. These cycles take years to correct. You can't just flip a switch.
It's just so wild. You have gas prices crashing, which makes it cheaper to drive to the grocery store.
Right.
But then once you get inside, the steak and the coffee are soaring. It creates a really confusing experience.
It's a very confusing psychological experience. You hear inflation is down on the news, but your personal inflation rate, if you have them like steak and coffee, feels like it's 20%.
And then there's the restaurant bill. The data showed restaurants are up 8.5%. That feels like a lot, too. Is that just the beef and coffee being passed on?
Partially, yes. Input costs matter. But we have to circle back to our favorite topic, that tax holiday.
Ah, the GST thing again?
Restaurant meals were one of the big categories in that tax break.
Yeah.
So an 8.5% jump looks huge. But a big chunk of that, 5 to 13%, depending on the province, is literally just the tax being put back on.
It's an administrative price hike, not an economic one.
Precisely. Same with alcohol, toys, games, all those things that were part of the holiday stimulus. They're all showing these artificial year-over-year spikes.
So from a retail perspective, it feels like a luxury tax on existence right now. The fun stuff, eating out, having a coffee, buying toys, a steak dinner, is statistically more expensive. The boring stuff, like driving to work, is cheaper.
It's a very austere kind of economy right now.
Okay, so that's the consumer side. It's a messy picture. But now, let's pivot to something that might actually make us some money. Because while we're complaining about the price of coffee, the analysts on Bay Street are looking at this environment and seeing dollar signs.
They really are. And this is where the conversation shifts to the TSX.
We have a report here from Scotia Capital that is, well, bullish is an understatement.
It's incredibly optimistic. It's the kind of report that makes you sit up and check your portfolio.
They're predicting record earnings per share for the TSX. They think EPS is going to hit $452. The previous high was $417. That is a significant breakout.
It's a massive breakout. And what's really fascinating is where they think that growth is coming from. It's not the banks, even though they're doing okay.
Yeah.
It's not tech. It is the materials sector.
This was the stat that made my jaw drop. They are predicting earnings growth in materials of 112%.
112%.
Year over year. That's staggering. I mean, usually you see projections of 5, maybe 10%. 112% is just, what on earth is driving that?
It's the shiny stuff, gold, silver, and copper.
The metals.
We are in the middle of a massive bull run for commodities. Gold prices have been surging. Global uncertainty, central banks are buying it up. When the world gets scary, people buy gold.
Right.
Silver is drafting behind it. And copper. Well, copper is the industrial story of the decade.
The whole electrification story. You can't build EVs or wind turbines or data centers without tons of copper.
Exactly. The report even highlights examples like the Canadian copper refinery in Montreal. These are real industrial assets that are suddenly just printing money because the price of the metal they refine has skyrocketed. This isn't speculative software revenue. This is rocks and metal being sold for way more than it costs to get them out of the ground.
So if you're a Canadian company pulling rocks out of the ground, 2026 is looking like a banner year.
It's looking like a record year. And Scotia Capital is saying this could be enough to pull the entire TSX up with it. It could rekindle interest from foreign investors who've kind of ignored Canada for a while.
Because we're resource heavy. When resources boom, Canada booms.
That is the classic Canadian story. And Scotia thinks this could finally help narrow that valuation gap between the TSX and the S&P 500.
Yeah.
The U.S. market has been so expensive and Canada has been so cheap. This might be the catalyst.
But there's always a but. There's a risk here, isn't there? Looking at a 112% growth prediction, that is a very high bar to clear.
It is an incredibly high bar. And Scotia highlights this risk. They call it the beat and raise trap.
The beat and raise trap. I love the term, but it sounds dangerous.
Yeah.
Explain that.
Okay, so imagine you're a student. If everyone expects you to get a C and you pull off a B, everyone is thrilled. Your stock goes up.
Right.
But if everyone expects you to get an A+, you have zero room for error. When analysts predict 112% growth, the market prices that in. The stock price today already reflects that success.
So if a company reports amazing earnings, but they aren't quite as amazing as expected.
Or if they don't raise their guidance for the next quarter to be even higher, the stock can crash.
So good news becomes bad news if it's not great enough news.
Exactly. The market gets finicky. It demands that perfect 1-2 punch. Beat the current number and raise the future outlook. If you miss either one, you get punished. We see this with tech stocks all the time, but now that pressure is shifting to the miners.
So it's a high wire act, and this applies to other sectors too.
It does. The banks are expected to grow by 10%. Energy is expected to rebound. But the vulnerability is high because the optimism is already baked in. You don't get credit for meeting expectations anymore.
Scotia did mention some potential upsides though, right?
They did. They see decent odds of things going even better. If global growth really picks up, that helps energy demand. If tariff pressures lessen, maybe the COSMA talks go well, that helps industrials.
And for the banks.
For the banks, if credit losses fall and housing stabilizes, they could easily beat that 10% number. So the thesis is materials are the rocket fuel, but the rest of the economy needs to hold steady.
Okay, so we have the inflation picture and the stock market picture. Let's bring it all home. The Bank of Canada. What do they do with this?
Oh, folks with their hands on the levers.
Usually the rule book is simple, right? Inflation jumps to 2.4, you raise rates. But if the core is cooling to 1.5, what's the move?
Well, the economists are split, but the consensus is shifting away from fear, which is interesting.
Okay, so what's the hold camp saying?
That's your BO, your CIBC. They're looking at this and saying, look, the economy is resilient, inflation popped up a bit, there is no fire to put out with rate cuts. So they're just arguing for a pause. Hold steady at 2.25%.
Don't touch it. But what is the market betting on? The bond market usually tells the real story.
And this is where the narrative has changed so fast. A few weeks ago, the market was actually scared of a rate hike. There was an 80% probability priced in that the bank might have to raise rates by the end of the year.
80%. That's terrifying for anyone with a variable mortgage.
It was a very hawkish sentiment. But after this report, because the core measures cooled so much, those bets just evaporated, dropped from 80% down to about 43% overnight.
So the fear of a hike is fading. The market looked under the hood, saw the tax trick, and calmed down.
Fading fast. The market is realizing the headline jump was a phantom.
And then you have someone like David Rosenberg. He's always a bit of a contrarian. What's his take?
Rosenberg is definitive. He called the data non-threatening. He isn't buying the panic at all. He just points to the 6-month trend of core inflation being under 2%. And he says, his quote was, There is no case here for the Bank of Canada to even think about raising rates.
No case to even think about it. I love that confidence.
He calls the inflation benign. He says the beast is dead, it's just the ghost of taxes past haunting the headline. He thinks the bank needs to focus on the underlying weakness in the economy, not this statistical blip.
So if I'm a homeowner trying to renew a mortgage, what should I expect?
The most likely outcome is a period of stability. The Bank of Canada will almost certainly look past the 2.4% headline. They're smart enough to get the math.
Right.
But because grocery prices are still high and the economy isn't falling off a cliff, they probably won't rush to cut rates deeper just yet.
So neutral, flat.
Flat is the new normal for a while.
Mm-hmm.
No new relief for borrowers, but hopefully no new pain either.
Which, honestly, after the last few years, I will take no new pain as a win.
It is a win. Stability lets people plan.
Okay, let's wrap this up. We've gone from tax policy to Vietnamese coffee farms to copper mines today.
It's been a global tour.
Let's crystallize the key takeaways for you. Point 1. Don't panic over that 2.4% inflation headline.
It's a tax calendar quirk. The underlying engine, the core inflation, is actually cooling, running below 2%.
Point 2. Budget more for your morning routine. The pain in the grocery aisle is real, but it's specific.
Coffee and beef are legitimate outliers. That's a supply shock, not monetary inflation, and it's not going away overnight.
Point 3. Check your portfolio. The TSX is poised for a potential record run, driven by a massive 112% earnings explosion in the materials sector.
Gold, silver, and copper are the stars. But watch out for that beat and raise trap. Expectations are sky high.
And point 4. The Bank of Canada is likely sitting on its hands.
The scare of a rate hike is fading fast. But don't expect aggressive cuts while coffee's up 30%. We're in a holding pattern.
It's such a fascinating mix. The cost of living is annoying, but the cost of investing might just be paying off.
It's a classic hedging scenario.
Yeah.
You might need those mining stock dividends to pay for your steak dinner.
That's the trade of 2026. Long copper, short cappuccino.
I like that. Put it on a t-shirt.
Okay, before we go, I want to leave you with one final provocative thought. We talked about that Scotia Capital prediction, the 112% growth in materials.
Right.
It's a massive number. So here's the question. If Scotia Capital is right, and the materials sector basically doubles its earnings this year, are you actually positioned for that? Are you overweight on gold and copper, on Canadian resources? Or are you, like so many people, still sitting on a pile of cash waiting for a rate cut that might not actually happen this year?
That's the uncomfortable question, isn't it? Cash feels safe, but if inflation is sticky at the grocery store and commodities are booming, cash might be the riskiest asset you can hold. You're losing purchasing power on one end and missing all the growth on the other.
Something to mull over while you sip your very expensive coffee. Thanks for tuning into this deep dive.
Keep your fuses lit.
See you next time.